And breaking this morning, one trade war is on after the U.S. retreated from two others. The Wall Street Journal declared this morning Trump blinks on tariffs against Canada and Mexico.
When it comes to the U.S. economy, we all want to believe it's built on unshakable foundations. But China just dropped a bombshell that threatens to pull the rug out from under America's key industries. This isn't just about tariffs or politics. This move could reshape global trade forever. From rare earth minerals to energy and technology, China has quietly been building a plan that's years in the making. And now, that plan is hitting America where it hurts most. How did this happen? What industries are at risk? And most importantly, how does this affect you? Stick with us as we uncover the full story. Because trust me, the details are more shocking than you think. What's happening? When the United States hit China with a staggering $60 billion in new tariffs in February of 2025, the strategy seemed straightforward. Economic pressure would force China to negotiate or change its trade practices. Many policymakers in Washington believed the tariffs would provide a protective barrier for American industries, helping to revitalize manufacturing and limit the flow of cheap imports. However, the expectation that China would back down underestimated the scale of China's long-term economic strategy. China had prepared for this scenario for years, if not decades. Rather than reacting hastily, Chinese leaders took a methodical approach, targeting key areas of American economic influence. The country not only imposed retaliatory tariffs, but also moved swiftly to tighten control over critical supply chains that power the global economy. This move extended well beyond temporary trade disputes. It signaled China's intent to gradually shift the global economic balance of power in its favor. China's counter-strategy, grounded in long-term planning, sent shockwaves through various industries, particularly technology, agriculture, and energy. Within days of the new tariffs, American companies began to feel the impact. Stock markets wavered, supply chains faced delays, and industries reliant on Chinese resources braced for further disruptions. As tensions escalated, China strategically identified pressure points within the United States, targeting industries with strong political influence. Targeting political pressure points. China's response was not random. Its leadership recognized that certain American regions and industries wielded significant political power. By imposing $35 billion worth of tariffs on U.S. exports, China aimed to create pressure from within. The targeted industries were closely tied to politically sensitive areas, such as soybeans from the Midwest and oil from Texas, where economic downturns could directly influence voting behavior and political attitudes. In the Midwest, where generations of farmers had relied on Chinese purchases of soybeans, the impact was immediate. Local economies, already stretched thin by previous trade disputes, experienced a sharp decline in income. Agricultural associations and state lawmakers began voicing their concerns, urging the federal government to reconsider its aggressive trade stance. Similarly, the energy sector, particularly in Texas and Louisiana, saw a reduction in exports of liquefied natural gas to China, one of its largest markets. Contracts were canceled and profits dipped as energy companies scrambled to find alternative buyers. The political implications were clear. The U.S. government's trade policy was creating internal resistance. Local leaders and business owners facing mounting financial pressures intensified their lobbying efforts in Washington. They called for a more balanced approach that would protect American jobs without sacrificing crucial international relationships. While tariffs made headlines, China was quietly applying an even more potent form of pressure by targeting its control over rare earth minerals. The weaponization of rare earths. Rare earth minerals, essential for manufacturing smartphones, electric vehicles, and even military hardware, became a pivotal point in China's strategy. With control of over 80% of the world's rare earth supply, China held a powerful advantage. It did not need to make loud threats. The mere hint of restricting exports to the United States sent waves of anxiety through American industries. Rare earth elements, including neodymium and dysprosium, are crucial for high-tech manufacturing. The automotive sector relies on these materials for electric motor components, while the defense industry needs them for missile guidance systems and radar technology. Without access to a stable supply, production timelines and costs in these sectors could spiral out of control. China's subtle yet effective messaging created a sense of urgency among American manufacturers. Companies began stockpiling rare earth materials, fearing future shortages. Analysts warned that any significant restriction on exports could cripple U.S. technological development and weaken national security. The situation underscored how deeply interconnected the two economies had become, despite ongoing trade hostilities. As if rare earth leverage was not enough, China also delivered a blow to America's energy sector by targeting one of its fastest growing export markets. energy wars, and the loss of strategic influence. China's next move involved the energy industry, where American producers had found a lucrative market for liquefied natural gas, also known as LNG. Over the previous decade, the United States had become one of the world's leading exporters of LNG, supplying fuel to power-hungry nations like China. However, after the new tariffs were introduced, China imposed taxes on U.S. energy imports, effectively cutting off one of America's largest energy markets. The immediate consequences were significant. U.S. energy companies faced delays in shipments and lost high-value contracts. In regions like Texas, where the energy sector drives local economies, job losses and reduced investment became a growing concern. Local refineries and transportation networks, which had expanded to support the booming export market, suddenly found themselves underutilized. China, meanwhile, accelerated efforts to secure alternative energy sources. It strengthened its partnerships with Russia and countries in the Middle East, signing long-term agreements to diversify its energy supply. At the same time, China invested heavily in renewable energy production to reduce its dependency on foreign fuel imports altogether. This strategic pivot not only weakened the U.S. position in the global energy market, but also showcased China's ability to adapt and outmaneuver its competitors. For the United States, the long-term implications were dire. Even if trade tensions eased, the damage to its energy influence could take years to repair. Markets that were once dominated by American exports were now shifting toward Chinese-led partnerships. With key industries under pressure and global alliances shifting, the trade war's ripple effects began reshaping the structure of international trade. China's network of new trade alliances. While the United States tightened its grip on tariffs, China focused on expanding its influence through a web of new trade alliances. Rather than isolating itself, China moved swiftly to deepen economic ties with nations across Asia, Europe, Latin America, and Africa. By signing long-term trade agreements with countries like Brazil, Russia, and members of the Association of Southeast Asian Nations, China sought to reduce its reliance on American goods and markets. This shift was not just about finding alternative suppliers, it was part of a broader strategy to increase China's leadership in global trade. China offered infrastructure investments, low-interest loans, and technology partnerships to developing economies. These initiatives, tied to the Belt and Road Initiative, positioned China as a dominant force in international commerce. European Union leaders, too, found themselves negotiating new terms with China to safeguard their industries and maintain access to growing Chinese markets. The result? The United States faced growing competition not just from China, but from a coalition of nations that now benefited from Chinese-backed trade routes and supply chains. American companies, once leaders in global markets, began losing contracts to Chinese counterparts. As China's trade alliances solidified, another battleground emerged: control over global technology. The new battleground. The trade war's most critical front became technology. The United States had attempted to limit China's access to advanced technology by banning exports of computer chips and blacklisting companies like Huawei. The goal was to protect national security and slow China's technological progress. However, these measures triggered a counter-response that accelerated China's push for self-reliance in the tech sector. China invested heavily in its domestic semiconductor industry, funneling billions of dollars into research and development. Tech companies in Beijing and Shanghai developed their own chips, artificial intelligence algorithms, and 5G infrastructure. By 2030, some experts predicted that China could surpass the United States in key areas of technology, including telecommunications and cybersecurity. Chinese tech firms also expanded their reach globally, signing deals with countries that had traditionally relied on American technology. In Africa and Latin America, Chinese-built data centers and telecommunications networks became increasingly common. These regions welcomed Chinese investment, which often came without the political conditions attached to American partnerships. This technological race posed a significant challenge to U.S. dominance. It was no longer just a matter of market competition. It was about shaping the future of global innovation and information security. As China advanced in technology, it also used its financial power to influence the world economy through strategic adjustments to its holdings of U.S. debt. Economic leverage through debt. China holds more than $800 billion in U.S. government debt, making it one of America's largest foreign creditors. Although selling off all this debt would harm China's own financial interests, subtle shifts in China's purchasing behavior had immediate consequences. After the imposition of new tariffs, China quietly reduced its investments in U.S. Treasury bonds, causing ripples throughout the financial system. This reduction made it more expensive for the United States to borrow money. As a result, interest rates on loans, such as home mortgages, car loans, and credit cards, began to rise. The higher cost of borrowing placed additional pressure on American consumers and businesses. Financial analysts warned that if China continued to limit its purchases of U.S. debt, the effects could be long-term, potentially destabilizing the national budget and slowing economic growth. China's careful use of financial leverage underscored a key point. Economic power is not just about tariffs and trade agreements. It is also about how nations control the flow of money in the global economy. For American policymakers, balancing the need to maintain economic pressure on China with the risks of financial instability became an increasingly difficult challenge. While China's debt strategy played out quietly, other nations directly affected by the trade war began reshaping their own economic relationships. Regional realignments. The trade war between the United States and China did not exist in isolation. Countries with strong trade ties to both nations found themselves caught in the crossfire. Canada and Mexico, America's closest trading partners, faced tariffs on key exports, prompting them to rethink their economic strategies. Canada retaliated by imposing duties on American agricultural products, while Mexico targeted U.S. steel and pork. However, these short-term measures were only part of the response. Both countries began seeking closer trade relationships with China to diversify their markets. Canada negotiated new agreements to export natural resources and agricultural goods to Chinese buyers. Mexico, meanwhile, strengthened ties with Chinese manufacturers, hoping to attract investments in automotive and electronics production. These developments marked a shift in North American economic dynamics. Traditionally, Canada and Mexico had relied heavily on the U.S. market, but the trade war exposed the risks of overdependence on a single partner. By building stronger connections with China and other international markets, these countries aimed to reduce their vulnerability to U.S. trade policies. The implications for American influence were significant. With Canada and Mexico exploring new economic alliances, the United States faced the possibility of losing leverage even within its own region. The long-term consequences of this shift could weaken America's standing as a leader in global trade. As regional realignments continued, the economic conflict began reshaping supply chains and industries in ways that would define the future of global commerce. Disruption and diversification of supply chains. The global supply chain, once heavily reliant on China, is undergoing seismic changes as companies scramble to adapt to new trade realities. The tariffs imposed by the United States on Chinese goods led to increased production costs for businesses that depend on Chinese-made components. In response, multinational corporations began to reassess their strategies, diversifying their manufacturing and sourcing operations to minimize risk. Countries such as Vietnam, Indonesia, and India emerged as key alternatives for companies seeking to relocate production. Over the past few years, significant investments have flowed into these regions, spurring the development of new industrial hubs. Tech giants and automotive manufacturers, in particular, found these nations attractive due to their lower labor costs and government incentives. However, moving supply chains away from China has proven to be more complex than expected. China's dominance in raw materials, especially rare earth elements crucial for electronics, batteries, and renewable energy technologies, remains a significant obstacle. Despite efforts to shift assembly and production, many companies still rely on Chinese suppliers for critical components. This reliance has created bottlenecks, forcing businesses to seek innovative solutions, such as recycling and alternative material development. The long-term impact of these changes is reshaping the global manufacturing landscape. For countries like the United States, this reconfiguration offers both challenges and opportunities. On the one hand, reduced dependency on China could enhance national security and economic stability. On the other, the high costs and logistical hurdles associated with rebuilding supply chains could hinder competitiveness in global markets. As businesses grappled with supply chain disruptions, entire industries began to feel the ripple effects of the ongoing trade war. Impact on key U.S. industries. Several U.S. industries have borne the brunt of the trade war's economic fallout, particularly those tied to manufacturing, technology, and agriculture. In the manufacturing sector, companies face skyrocketing costs for raw materials and components due to tariffs. Industries that relied on Chinese steel and aluminum were hit particularly hard, with some businesses forced to shut down or relocate production overseas to remain viable. In technology, the effects were equally profound. The US government's efforts to block Chinese tech firms from accessing critical technologies led to retaliatory measures from China. American tech companies that previously relied on Chinese markets and supply chains found themselves struggling to maintain operations. Restrictions on semiconductor exports, for example, disrupted the production of smartphones, computers, and automotive electronics. Meanwhile, the agricultural sector faced a different set of challenges. China, once a top buyer of American crops like soybeans and corn, redirected its purchases to Brazil and Argentina. American farmers experienced declining revenues, leading to increased debt and, in some cases, the foreclosure of family-owned farms. Although federal subsidies provided temporary relief, many farmers worried about the long-term viability of their businesses if Chinese markets remained closed to them. This industry-wide instability has raised concerns about the United States' ability to maintain its global economic leadership. Policymakers and business leaders alike have called for strategic investments in domestic industries to reduce vulnerability to foreign trade policies. Initiatives aimed at boosting advanced manufacturing, renewable energy, and technological innovation are now central to discussions about America's economic future. While these industries faced immediate economic hardships, financial markets experienced their own form of turbulence. Volatility in global financial markets. Financial markets thrive on stability, and the escalating trade war between the United States and China introduced unprecedented uncertainty. Each new round of tariffs and retaliatory measures sent shockwaves through global stock exchanges. Market analysts observed that major indices like the Dow Jones Industrial Average and the S&P 500 experienced wild fluctuations with significant drops following negative trade news. Investors, concerned about slowing economic growth and disrupted supply chains, began shifting their portfolios towards safer assets such as government bonds and precious metals. This trend put additional pressure on corporate earnings and investments. Companies that relied heavily on international trade saw their stock prices plummet, affecting not only shareholders but also pension funds and retirement accounts for millions of Americans. The unpredictability extended beyond U.S. borders. European markets faced increased costs for goods tied to U.S.-China trade, while developing nations dependent on raw material exports to China struggled to maintain economic stability. In Southeast Asia, governments implemented measures to stabilize their currencies and attract foreign investment, hoping to capitalize on shifting supply chains. Central banks around the world took notice of these developments, with some adjusting interest rates to counteract the economic slowdown. The Federal Reserve, for example, signaled a cautious approach to rate hikes, citing the potential risks posed by prolonged trade tensions. However, critics argued that monetary policy alone could not resolve the deeper structural issues affecting global trade. As markets reeled from uncertainty, the broader question of global economic leadership became increasingly relevant. Economic leadership. The trade war has accelerated a global power shift, with China positioning itself as a viable contender for economic leadership. Through strategic investments and partnerships, China has expanded its influence across multiple continents, challenging the traditional dominance of the United States in global affairs. The Belt and Road Initiative, launched over a decade ago, has played a central role in this transformation. By funding infrastructure projects in Asia, Africa, and Europe, China has created new trade corridors that bypass traditional routes controlled by Western powers. These investments have strengthened China's economic ties with key partners, giving it leverage in negotiations on issues ranging from trade to technology. China's growing role in international finance is also reshaping the global economic order. The establishment of institutions like the Asian Infrastructure Investment Bank has provided developing countries with an alternative to Western-led organizations such as the International Monetary Fund and the World Bank. This shift has been particularly appealing to nations seeking to avoid the stringent conditions often attached to Western loans. However, China's ambitions have not gone unchallenged. The United States and its allies have responded by promoting their own initiatives aimed at countering Chinese influence. The European Union has launched programs to strengthen its internal market and enhance its competitiveness in key industries. Meanwhile, the United States has prioritized initiatives to expand trade agreements with Indo-Pacific nations and invest in emerging technologies. The rivalry between the United States and China is no longer limited to tariffs and trade deals. It is a contest over who will define the rules and norms that govern the global economy in the 21st century. As global leadership strategies evolved, the effects of the trade war began to extend to America's closest neighbors, including Canada. The impact of U.S. protectionism on North American integration. The close economic ties between the United States, Canada, and Mexico have long been central to North American trade. The North American Free Trade Agreement, and later its successor, the United States-Mexico-Canada Agreement, created a framework for seamless trade across the continent. However, U.S. protectionist policies, including tariffs and new trade restrictions, began to strain these relationships. Canadian and Mexican leaders expressed frustration with the unpredictability of U.S. trade policies. While the USMCA aimed to modernize trade rules, the frequent imposition of tariffs undermined the agreement's intent. Cross-border businesses faced uncertainty over whether their operations would be disrupted by sudden policy changes. Additionally, U.S. tariffs on goods like auto parts and electronics hurt not only Chinese producers, but also North American suppliers and manufacturers. Factories that sourced components from multiple countries in the region found themselves entangled in bureaucratic red tape and increased costs. This eroded the competitiveness of North American industries in global markets. Efforts to strengthen regional cooperation gained momentum in response. North American trade summits focused on improving supply chain resilience and reducing reliance on external markets. Initiatives to develop joint strategies for rare earth mineral production, technological innovation, and labor mobility were proposed as ways to bolster the region's economic security. Canada's struggles with U.S. trade policies. When the United States imposed its sweeping tariffs on China, the effects rippled far beyond the two countries. Canada, America's largest trading partner, found itself in an unexpected predicament. The U.S. tariffs on imported steel and aluminum hit Canadian producers hard. As a response, Canada retaliated with its own tariffs, targeting key U.S. exports such as farm products, whiskey, and consumer goods. Businesses reliant on both American and Chinese supply chains suddenly faced increased costs and market volatility. Industries like automotive manufacturing, which are deeply integrated across North American borders, struggled with disruptions. Factories that relied on just-in-time supply systems saw delays as both raw materials and finished goods faced tariff-related bottlenecks. Additionally, the agricultural sector, especially Canadian wheat and beef exporters, experienced fluctuating prices as global demand shifted. To counter these effects, the Canadian government introduced economic relief packages to support affected industries. However, critics argued that these measures were insufficient to protect Canada's long-term economic interests. As one of the most trade-dependent economies in the world, Canada could not afford prolonged disruptions to its largest trading relationships. While Canada sought to protect its industries, it also looked outward, forging new alliances to safeguard its economic future. Canada's pivot toward China and other trade partners. In response to the escalating trade war, Canada began to reassess its trade priorities. Historically reliant on the United States for the majority of its exports, Canadian policymakers recognized the need to diversify their markets. China, with its growing demand for natural resources, presented an attractive alternative. Over the past few years, Canada strengthened trade ties with China through agreements on resource exports, particularly energy and minerals. Chinese investments in Canadian infrastructure projects increased, including initiatives to enhance railways and ports for the transport of goods. However, this growing relationship was not without controversy. Critics warned that increased economic dependence on China could leave Canada vulnerable to future geopolitical pressures. At the same time, Canada expanded its trade networks in other regions. Through its membership in the Comprehensive and Progressive Agreement for Trans-Pacific Partnership, Canada secured access to fast-growing markets in the Asia-Pacific. The European Union also became a key partner through the Comprehensive Economic and Trade Agreement. These moves aim to reduce Canada's reliance on any single economic power and ensure greater resilience in the face of global trade tensions. Despite these diversification efforts, Canada's agricultural sector became a focal point in its adaptation to new trade realities. Canada's agricultural sector adapts to the global trade landscape. Canada's agricultural sector, like its U.S. counterpart, faced significant challenges due to the shifting dynamics of global trade. The retaliatory tariffs imposed by both the United States and China disrupted traditional markets for Canadian crops and livestock. Farmers who once relied on stable export relationships found themselves in a precarious position. For example, Chinese tariffs on U.S. soybeans indirectly affected Canadian producers. As China turned to South America for its soybean needs, Canadian farmers saw increased competition and fluctuating prices. Similarly, Canadian wheat and beef exports encountered new hurdles as global markets became more fragmented. In response, Canadian farmers began to innovate and diversify their operations. Many turned to specialty crops, such as lentils and organic produce, which had growing demand in Asian and European markets. Investments in agricultural technology also increased, with farmers adopting precision farming techniques to optimize yields and reduce costs. The Canadian government played a crucial role in supporting these adaptations. Programs aimed at expanding export opportunities and providing financial assistance to struggling farmers were implemented. Additionally, trade missions to emerging markets helped open new avenues for Canadian agricultural products. Despite these efforts, the long-term outlook for Canada's agricultural sector remains uncertain. The global trade environment continues to evolve, with new alliances and rivalries shaping the flow of goods. For Canadian farmers, the challenge is to remain agile and competitive in a world where economic power is constantly shifting. As the trade war continues to reshape economies worldwide, the question remains, how can North America maintain its stability in an increasingly interconnected and competitive global landscape? The trade war between the United States and China has sent shockwaves through the global economy, reshaping industries, supply chains, and trade relationships. From technology to agriculture, nations are scrambling to adapt, while North America faces mounting pressures to strengthen its regional ties and economic strategies. The question that lingers is whether these shifts will lead to long-term resilience or greater instability. What do you think? Will the United States regain its competitive edge, or is China positioning itself to dominate global markets for the foreseeable future? How will Canada's growing ties with new partners impact North America's trade alliances? We would love to hear your thoughts in the comments. How do you see this trade war affecting everyday life, prices, jobs, or even your own industry? Thanks for watching, and see you in the next one.